Rewards credit card. This is the type of credit card most people think of first. It works like a normal credit card, but it gives something back when you spend. That return may come as points, miles, or cash back depending on the card. Rewards cards became popular as banks realized they could turn everyday spending into a loyalty system, much like airlines and hotels had done earlier. What makes this card different is that it tries to make regular purchases feel more valuable. It matters because for someone who pays in full each month, rewards can add up over time. But for someone who carries a balance, the interest can quickly erase that benefit. Student credit card. This card is aimed at young adults who are just beginning to use credit, often while in school or shortly after. Because the user is new to credit, the card may have a lower limit and simpler features than premium cards. Some student cards include small rewards, but the real purpose is often credit building rather than perks. It matters because it introduces people to borrowing, billing cycles, and credit history at an early stage, when habits are still forming. Secured credit card. This card is designed for people who are building credit or rebuilding it after problems. To open the account, the cardholder usually has to place a cash deposit with the bank, and that deposit often becomes the credit limit or helps support it. The card still works like a credit card for purchases and payments, but the deposit lowers the lender's risk. Secured cards matter because they give people a path into the credit system when they might not qualify for a regular card. In many cases, they are the starting point for someone trying to establish a financial record. Unsecured credit card. This is the standard form of credit card that does not require a cash deposit. The lender is extending credit based on the cardholder's credit history, income, and general financial profile. Most mainstream rewards cards, travel cards, and everyday credit cards are unsecured. What makes this different from a secured card is that the bank is taking more risk, which is why approval usually depends more heavily on creditworthiness. It matters because this is the form of credit card most people eventually move into once they have established a stronger financial record. Premium credit card. This card sits at the higher end of the market and usually comes with a larger annual fee, richer rewards, and extra perks. These may include airport lounge access, travel credits, concierge services, purchase protections, and elevated earning rates in certain categories. What makes premium cards different is that they are trying to be more than payment tools. They are marketed as lifestyle products. They matter because the benefits can be valuable, but only if the cardholder actually uses them enough to justify the cost. Travel credit card. This card is built around travel-related rewards and benefits. Instead of simple cash back, it usually earns points or miles that can be used for flights, hotels, or other travel expenses. Many of these cards also include benefits like travel insurance, airport lounge access, or no foreign transaction fees. Travel cards grew alongside airline and hotel loyalty systems, and they are designed for people who want more value from frequent trips. It matters because the rewards can be strong, but only if the cardholder actually travels enough to use them well. Starter credit card. This is a broad category for people with little or no credit history. It overlaps with student and secured cards, but it is not always tied to school or a deposit. The bank is usually offering a simpler product with lower limits and fewer extras in exchange for taking a chance on a newer borrower. What makes it different is that it is less about maximizing rewards and more about creating a foundation. It matters because a person's earliest credit card often shapes their credit profile for years afterward. Balance transfer credit card. This card is designed for moving existing debt from one card to another, often with a temporary low or 0% introductory interest rate. The idea is to give the cardholder time to pay down the balance without interest growing as quickly. These cards became especially popular as banks competed for customers already carrying debt elsewhere. It matters because a balance transfer can help someone organize and reduce debt, but only if they avoid adding new balances and pay attention to transfer fees and promotional deadlines. Low-interest credit card. This card focuses less on rewards and more on keeping the interest rate lower than average. It may not have exciting perks, but it is meant for people who value borrowing cost over bonus features. In practice, this kind of card can matter most for someone who may occasionally carry a balance and wants to reduce the long-term cost of doing so. It is different because it puts practicality ahead of rewards marketing. Business credit card. This card is built for business spending rather than personal household expenses. It is often used by small business owners, freelancers, and companies that need to separate work expenses from personal ones. Many business cards include rewards tailored to office supplies, advertising, travel, or software spending. What makes them different is not just the rewards, but the way they help organize business cash flow and record keeping. They matter because they can simplify expense tracking and make business finances easier to manage. Store credit card. This card is connected to a specific retailer or store group. It usually offers special financing, store discounts, or loyalty rewards when used with that brand. Store cards became common as retailers realized they could deepen customer loyalty by tying spending directly to shopping incentives. What makes them different is that they are often easier to get than major bank cards, but they may have higher interest rates and narrower usefulness. They matter because they can look attractive at checkout, though the value depends on how often the shopper actually uses that store. Charge card. This card looks similar to a credit card, but it traditionally works under a different rule. The balance is usually expected to be paid in full each month. Instead of revolving debt the way many credit cards do, charge cards were built for people and businesses who wanted purchasing flexibility without long-term borrowing. Historically, some of the earliest premium payment cards followed this model. It matters because the spending pattern is very different. A charge card encourages full monthly repayment and often targets users with stronger income or spending habits.